Welcome to the Level 1 Financial Reporting and Analysis Summary video series. This video is a summary of the reading on understanding income statements. The first point here is to understand revenue recognition criteria. And US GAAP and IFRS say roughly the same things, but I will still emphasize what both standards say. This is what IFRS says. The amount of revenue can be measured reliably. So this condition needs to hold true when you recognize revenue. Also, it is probable that economic benefits associated with the transaction will flow to the entity. Stage of completion of the transaction can be measured reliably. Transaction costs can also be measured reliably. So when these hold true, then a company can recognize revenue. This is what US GAAP says. Evidence of arrangement between buyer and seller exists. So there is some sort of a contract. Product has been delivered or service rendered. Price is determined or determinable. Seller is reasonably sure of collecting money. Now, just as a slight clarification of the first point, evidence of arrangement between buyer and seller. If it's a cash transaction, then that cash transaction is also evidence that the transaction took place. Sometimes you'll see this phrase, realized or realizable and earned. So if the revenue has been earned in the sense that the product has been delivered or the service has been delivered and the money is either received or you are sure you will receive the money, then you can recognize revenue. Revenue recognition in special cases. There are two special cases that the curriculum emphasizes. One is long-term contracts and the other is installment sales. Long-term contracts span multiple accounting periods. There are different methods of allocating revenue across periods. The simple example that can come to mind when we talk about long-term contracts is construction of a highway. Let's say a construction of a highway will take 5 years. You are the construction company and you are receiving, let's say, most of your money in the first 2 years. Do you recognize revenue in the first 2 years or do you recognize over 5 years? That is the question. So what does this depend on? Let's say the outcome can be measured reliably, and that means that you are sure, roughly speaking, of what your expenses will be. If that is indeed the case, then you can use the percentage of completion method, which means that let's simplistically say that over 5 years, every year your percentage completion will be 20%. Then what you can do is recognize 20% of your revenue every year. The other scenario is where the outcome cannot be measured reliably. And this happens quite often because, let's say, with that highway construction project, your estimate is just a rough estimate. The actual expense might end up being much higher. Then what do? Then you cannot use the percentage of completion method. Then according to IFRS, use this method where we set revenue equal to cost. So in every period, the revenue recognized is equal to the cost incurred. US GAAP is more conservative. US GAAP says that you only recognize revenue after having completed the project. Then the next scenario is installment sales. Here you sell your product or sell your service. Generally with installments it would be a product that you are selling, and then you receive payments over a long period of time. Two possibilities. One is that you are reasonably sure of collecting all payments, and the other is where you are uncertain about collecting payments. If you are reasonably sure, then simplistically this is like a sale. You can recognize the revenue and book a lease or installment receivable. The slightly more detailed explanation is given here. Separate installments. So all the payments that you get, you separate into a sales price and an interest component. When you do that, you can recognize the sales price immediately, but the interest component will be recognized over time. The other is installment method. Here, profit is equal to cash times expected profit as a percentage of sale. So this expected profit as a percentage of sale you will know upfront because you know your expected profit, you know the sale, so you know this number. Then in every period you receive a certain amount of cash and the profit is based on that. In our regular videos, we have gone through an example based on this, and I'm sure if you're doing practice, then you will see questions related to this concept. The other way of dealing with this is the cost recovery method, where you first recover your cost and then you book any profit after that. Next, we talk about barter transactions and gross versus net reporting. First, barter transaction. You need to know the definition of a barter transaction. If two companies A and B exchange goods and or services in a non-cash transaction, that is called a barter transaction or a barter trade. A special case of a barter transaction is a round-trip transaction. This involves the sale of goods to one party with simultaneous purchase of almost identical goods from the same party. Now, how do we deal with this? According to IFRS, we use the fair value of revenue from similar non-barter transactions with an unrelated party. Unrelated in this context would be a party other than A and B. US GAAP treatment says that we have to use the fair value of revenue only if the firm has historically received cash payments for such goods and services and can use historical experience to determine fair value. So US GAAP is a little more conservative. Next point has to do with gross reporting versus net reporting. The classic example that you think of here is a travel agent. So a travel agent sells you tickets. Should they show gross revenue or net revenue? Under gross reporting of revenue, the selling firm reports sales revenue and cost of goods sold separately. Under net reporting, the difference in sales and cost is reported. If you take the travel agent example, it really doesn't make sense for them to show revenue based on the value of the tickets they sell you. It makes more sense for them to do net reporting, where the difference between the ticket and the cost to the travel agent is what is reported. So specifically, under what circumstances should a company report gross revenue? These are the scenarios. So if the entity is the primary obligor means the entity has the obligation to deliver the service. The party bears inventory and credit risk. So for example, if the entity is selling tickets, then the risk of the seat not being utilized needs to be with the entity that is doing gross reporting. Ability to choose supplier and latitude to establish price. You'll notice that with the travel agent, these conditions don't hold, therefore they should not be using gross reporting. Now we come to expense recognition. First, a quick definition. Expenses are decreases in economic benefit during the accounting period in the form of outflows or depletion of assets or incurrence of liabilities that result in decrease in equity. So key point is decrease in equity. Decrease in equity can happen because assets go down or liabilities go up. And both those scenarios are covered in the definition. The matching principle. Expenses to generate revenue are recognized in the same period as revenue. Period costs or period expenses are reflected in the period when the expense is incurred. Three important types of expenses from a testability perspective are shown here. One is doubtful accounts, also called bad debts. This has to do with the fact that some customers will default. When revenue is recognized, estimate uncollectible amounts. The point is, if you make $100,000 worth of sales in a given period, the bad debt will become obvious later. But based on past experience, if you know that for this sale, 5% of this number will not be recovered, and let's say that this is 100,000 credit sales, then that 5% bad debt needs to be shown as an expense in this period, not later when you actually realize which customers are going to default. And this has to do with the matching principle. Also, warranties. Estimate future warranty expense and recognize as estimated warranty expense during the period of sale. If you sell 100,000 worth of computers this period and you expect that warranty claims will come in next period, the warranty expense needs to be shown in this period. Again, this has to do with the matching principle. Depreciation and amortization. You buy a machine that you will use for 10 years. You incur the expense of 50,000 in the first year where you buy the machine. But since you will be using the machine and generating revenue over 10 years, what you do is spread this cost over 10 years through the depreciation mechanism. Again, an illustration of the matching principle. Non-recurring items and non-operating items. Analysts are generally trying to estimate future earnings. Hence, reporting standards require firms to separate income and expense items which are likely to continue from items which are not likely to continue. The items that are not likely to continue fall under discontinued operation. This is an operation which a company has disposed or plans to dispose. So in a given year, you are running a plant, but at the start of next year, you have decided to sell it off, dispose it. You still need to report, but how do you report? Net income from discontinued operations is shown net of tax after net income from continuing operations. Next item, extraordinary items. This is an item which is unusual and infrequent, so remember that, shown net of taxes below discontinued operations, and this is purely a US GAAP concept. IFRS does not have any concept of an extraordinary item. Next is unusual or infrequent items. Examples include restructuring charges and gain losses from sale of equipment. These items are highlighted but need to be shown as operating expenses. Non-operating items are typically reported separately from operating income because they are material and or relevant to the understanding of the company's financial performance. Important to note here that you as an analyst are going to be concerned about the operations of a company, so you need to understand what the operating expenses are and what are the non-operating expenses. That's why it's important for companies to separate the two. Also note that under IFRS, a definition of operating activities is not given, which means that the company that is reporting has the discretion to determine what is operating and what is not operating. The company has to use judgment, and you as an analyst need to determine whether the company is using good judgment or not. Changes in accounting policies. New standards might require companies to change accounting policies. Companies may be allowed to adopt standards prospectively or retrospectively. Changes in accounting principle require retrospective application. Retrospective means that also past reports need to be represented. For example, if a company that was using last in, first out for inventory moves to first in, first out, then it needs to show the previous year's reports also using this new FIFO standard. And this has to do with the principle of comparability. If this is not done, then you can't compare numbers across periods. Changes in accounting estimates require prospective application. For example, a change in the useful life of depreciable assets. If this goes from 8 years to 10 years, then you do not need to change last year's financial statements. Correction of an error for a prior period requires a restatement of the 4 major financial statements for prior periods. If a company does this too often, then that is a major red flag. Earnings per share. This is perhaps one of the most important metrics in finance, because when you are evaluating a company, you look at earnings per share and you are often concerned with the growth rate of earnings per share. So I'd say that the probability of getting a question on this topic is very high. Basic earnings per share is net income minus preferred dividends divided by weighted average number of shares outstanding. On your exam, the tricky aspect here is figuring out the weighted average. So keep in mind that over a given year, let's say a company starts with 10,000 shares. Then after 6 months, if a company issues 2,000 more shares, then you take a weighted average. In this case, it would simply be 10,000 shares for 6 months and then 12,000 shares for another 6 months. So you take the weighted average. So 10,000 into 6 over 12 plus 12,000 into 6 over 12. Then the other scenario is where a company might do a treasury stock operation. So instead of issuing shares over here, let's say the company buys back shares. Then you have 10,000 for 6 months and 8,000 for 6 months. And then the next tricky item is where there is a stock split. If there is a stock split at some point, let's say there is a 2-for-1 split, then what you assume is that the split was always in effect. This 10,000 then becomes 20,000, the 2,000 becomes 4,000. And hopefully what I'm saying is a refresher, and you should have done questions based on this. In our regular lecture, we go through several examples that explain this concept in more detail. The next is diluted EPS, which is net income, and this is in brackets because what we are doing is saying that we look at the net income assuming that securities that can be converted into common shares are indeed converted to common shares. If that happens, then the net income is denoted by this numerator. And we divide by the weighted average number of shares outstanding plus new shares that would have been issued at conversion. So this method of coming up with the diluted EPS is called the if converted method, because you are saying that if these shares that can be converted into common shares are converted, then what is the net income and what is the weighted average number of shares? You need to know how to deal with convertible preferred stock, convertible bonds, and employee options. With convertible preferred shares, both the numerator and denominator increase. Numerator increases because then you are not going to subtract the preferred dividends, and denominator increases based on how many new common shares are created when the preferred shares are converted. With convertible bonds, the numerator increases because you are saying that in the original net income number the interest had been deducted, so now you add back interest on an after-tax basis, interest into 1 minus t. Also the denominator increases because you have more shares. The third scenario is employee options, where a company has issued stock options. The analyst is saying that, look, if those stock options are exercised, then what will the EPS be? The numerator stays the same because there is no impact to the net income minus preferred dividends, but the denominator changes. The denominator increases because when shares are exercised, then obviously the company needs to issue new shares. So let's say a company has to issue 100 new shares. But then when options are exercised, the employees who are exercising the options have to give the company money, the strike price. The assumption in this method is that that money is going to be used to buy back shares from the open market. Let's say that the number of shares bought back from the open market equals 50. Then the net number of new shares created would be 50. Some convertible securities could be anti-dilutive. Anti-dilutive securities are not included in the calculation of EPS. So the point being that in the first two scenarios, convertible preferred and convertible bonds, both the numerator and denominator went up. Normally, when you do have such convertible securities, the diluted EPS becomes less than the basic EPS. So that is a normal situation, and we say that the securities are diluted. But if under certain circumstances the diluted EPS actually increases, let's say you have basic EPS of 2.0 and you do the calculation and you get a diluted number of 2.1, then those securities are called anti-dilutive. And on your financial statements, if you report the diluted EPS, you will not report 2.1, you will report 2.0. Next point, analysis of the income statement. So the key point here is to understand the concept of a common-sized income statement. With a common-sized income statement, you take every income statement item and show it as a percentage of net sales. Sometimes you might see this written as percentage of revenue. So that is done over here. The point then being that you can see that cost of goods sold in 2011 was 50% of sales. In 2012 it went up to 58.5% of sales. You can see the gross profit margin very easily. You can see the operating profit margins, you can see the net profit margins. So this is a quick way of analyzing the income statement. Comprehensive income. Comprehensive income is equal to net income plus other comprehensive income. This is what you see on the income statement. But there are situations where assets go up, but the increase in assets are not shown on the income statement. For example, with securities that are tagged as AFS. Where does the unrealized gain in AFS go? This goes to other comprehensive income, which is a part of equity. So let's ignore 2, 3 and 4 for now. If you have, let's say, 2 million in terms of unrealized gain on AFS securities, is the 2 million showing up in net income? No. But is equity going up? Yes. So that 2 million is part of comprehensive income, even though it's not part of net income. And the 2 million shows up in OCI. If you want to report the comprehensive income of a company, then you take net income plus the other comprehensive income. For now, you need to remember the other 3 items that also show up in OCI. Foreign currency translation adjustments, unrealized gains, losses on derivative contracts used for hedging, and certain costs of a company's defined post-retirement plans. If you found this lecture helpful, then I'll be very grateful if you can do 3 things for me. Number 1, like this video. Number 2, like my Facebook page. And number 3, visit analystforum.com and there add my logo to your studying with profile. You can see this slide for help on how to do that. Thank you very much and good luck with your studies.